Welcome to our guide on navigating your first home purchase. Today, we'll be exploring whether buying a home at 23 is a viable option for young professionals. In this video, we'll go through understanding your financial situation, evaluating the buy versus rent dilemma, key considerations for a home purchase, and finally, actionable steps you can take. Let's dive into your current financial situation. You're 23, working remotely, earning $75,000 per year, living at home with minimal expenses, and investing a good portion of your income. You're considering buying a home in Philadelphia, perhaps a 2-bedroom, 1-bathroom, for around $275,000, and planning to rent out a room to help with costs. Additionally, you plan to take advantage of a first-time homebuyer program. You also have a Roth IRA and a taxable investment account. Now, let's evaluate your dilemma. Purchasing a home means you would need to liquidate a substantial portion of your investment portfolio to cover the down payment and closing costs. On the other hand, continuing to rent allows your investments to potentially grow. The crux of the matter boils down to whether you are financially ready and if the personal factors align with home ownership. Before making a decision, it's crucial to consider several key aspects. Financial readiness includes ensuring you have an emergency fund for unexpected expenses, accounting for all costs such as down payment, closing costs, and potential big-ticket items like a car purchase. You should also be aware of current interest rates and their impact on mortgage payments. Remember, a mortgage is the minimum amount you'll pay monthly, while rent is the maximum. Homeownership involves additional costs like property taxes, insurance, and maintenance. On the personal side, think about your experience of living alone. Do you have a realistic understanding of the related costs? Managing a rental property and finding a compatible roommate can be challenging, and although remote work offers flexibility, you should assess your long-term job security. To wrap up, here are some steps you can take right now. First, prioritize building an emergency fund for unexpected costs before making any large purchases. Consider renting for a year to gain insights into your real spending habits, preferred living areas, and the true costs of independent living. Assess your investment portfolio to determine if liquidating investments for a home purchase is financially sound, considering the potential for future growth. Finally, look at the current market conditions, especially interest rates, and how they're trending. Now it's time for a quick quiz. What is a critical financial factor to consider when buying a home? Is it A, down payment, B, interest rates, C, emergency fund, or D, all of the above? You may pause the video now to think about the answer, and we'll discuss it in the next section. The correct answer is D, all of the above. It's imperative to consider the down payment, interest rates, and having an emergency fund when evaluating your readiness to purchase a home. To sum up, evaluate both your financial and personal readiness, as these will significantly impact your decision. Consider whether buying a home aligns with your current lifestyle and future goals. Don't rush this decision. Ensure you take actionable steps and carefully plan for a sound financial future. Thanks for joining us on this journey through your first home purchase. Be sure to like, subscribe, and comment below with your thoughts and experiences. We'd love to hear from you as you navigate this exciting phase of life.